Hey, Diana, did you know that scaling up your law firm is easy?
Mark, that's the dumbest thing you've ever said.
Ladies and gentlemen, jurists and just curious, welcome to the Successful Barrister podcast. Here you'll learn about marketing, management, and life skills for lawyers that probably won't get you disbarred. Hosted by Mark Whitehead, a seasoned lawyer who remembers when fax machines were cutting edge, and Diana Berry, attorney, COO, and the brains behind the scenes. Together, they are the legal world's most dynamic duo since statutes met regulations. So if you're looking to build a practice, not a prison, you're in the right place. Welcome to the Successful Barrister, where legal legends are made.
And welcome to the Successful Barrister podcast, the podcast for lawyers and law firm leaders about marketing, management, and life skills that probably won't get you disbarred. I am your host, Mark Whitehead, alongside here my number one, that's your new name, number one.
It's gonna take a while to get used to
Yes,
that.
I know. My number one, Diana Berry, my COO. Hey, Diana, what's up?
Not much. How are you?
Good. So as we sit here recording, we're on a Friday afternoon, and I can just tell you are just busting to get the hell out of this office, aren't you?
No, Mark. What makes you think that? Other than the fact that I told you I was.
She's mad at me. She's like, why are we doing a podcast on a Friday afternoon? I want to go.
I think that this is one of the best management skills that we can teach our listeners, just impart on our listeners. Stack the deck in your favor and do the best things that you can at the start of your week, and the things you're not going to do so well at, like podcasting for Diana. I just talked about myself in the third person.
You did, didn't you?
This is going to be a fun recording, and we're talking about numbers.
Numbers. Yes, we are.
Two lawyers talking about numbers.
Great. All right. So here we go. So here's what we're doing today. So last week, I think actually 2 weeks ago, we did a podcast on the EOS system. And of course, we are EOS aficionados. This is the system that we use, the entrepreneurial operating system by Gino Wickman via his book Traction. We've talked about that probably way too much on this podcast. One of the interesting things about Gino Wickman is he is a break-off from the Scaling Up organization, which actually I think it actually is called EO as opposed to EOS, the Entrepreneurial Organization. Funny how similar they are in names.
Yes.
And of course, that is founded by I'm blanking on Verne Harnish.
Mm-hmm.
So
who we've talked about.
So Gino Wickman broke away from Verne Harnish, and I think they probably have said a few words back and forth on social media a little bit about each other. But they both have operating systems that small businesses, law firms like ourselves, can use, and we chose the EOS system. And I think we've said it before in this podcast, we use it for its simplicity. However, there is one piece of the EOS system that, in my opinion, is lacking. It is in that it does not deal with the issue of cash and cash flow, of which the scaling up model does deal with. So, in our firm, we run the EOS system, but at the upper level, at the finance committee level, we do incorporate a bit of the scaling up cash flow model to our organizational system. So I thought today, as a supplement to the EOS podcast that we did a couple of weeks ago, we would add the cash flow model from Scaling Up and talk a little bit about it and about how we use it in our law firm and about how it might benefit our listeners out there.
So just to make sure that I understand, because I have not read Scaling Up. Obviously, you talk about him a lot, so I'm familiar by just tangentially. So he's got a very similar platform like EOS, but today we're only going to talk about the cash flow portion.
Well, we'll mention a little bit. So Scaling Up
significantly, we'll talk about the cash flow.
Right, we're going to talk about the cash flow. I mean, so it's funny. So Scaling Up talks about people, strategy, and execution. Sound very similar to Traction.
Similar. Yep.
Extremely similar. And the fourth thing they talk about is cash, which is the one thing that is different. Mm-hmm. And why does cash matter? Verne's quote is, "Revenue is vanity, profit is sanity, cash is reality." It's one of the most important and most ignored truths in law firm management. You can go a long time without making a profit, but you cannot operate one day if you don't have cash. You must have cash.
And those are two very separate things, two very separate statements, financial statements, two separate ways to track it all. And even though I took I took a significant number of accounting classes in undergrad, it's still very hard to remember that, I think, when you're running a business, and especially for lawyers who ended up as accidental law firm owners.
Right. So, I think we ran this analogy, I want to say a month ago. But let's say, for example, you show $100,000 in profit for whatever you're looking for, the month, the quarter, the year, whatever. Well, do you have $100,000 in cash flow?
No.
No, absolutely not. 40% of it, let's call it 40% for fun's sake, 40% of it goes to the government. So now your $100,000 profit turned into $60,000. Well, let's say that you have a line of credit that you have to pay back. Okay, well, you can deduct the interest expense that came off your P&L, but the principal payment that you made back, let's say you paid them back $20,000, that comes off of cash. So now you're down to $40,000. Let's say you have advanced case expenses, which are a non-deductible item. Let's say in whatever period we're talking about, you spent $10,000 on developing cases. Let's say you're a PI firm and you've got to pay for records, you've got to pay for experts, whatever it is. Well, that comes off of cash. So now you're down to $30,000. So you just now had $100,000 in profit on your P&L, but you've only got $30,000 in the bank. What the hell happened? And this happens to law firms all the time, that they don't understand, where did the cash go?
Yeah. Well, and as you pointed out at that podcast, you still pay the taxes on the $100,000.
And you're paying the taxes on $100,000. You're not paying the taxes on the $30,000.
The brutal truth about that. And so I think that was, for listeners, that was the Atticus cash flow drivers podcast, if you want to go back and reference that. So today, Mark, we're going to take a look at Verne Harnish's scaling up, particularly with some emphasis on the cash portion, right?
Yes. Without cash, your business dies, regardless of how strong your culture is, your operations might be, even what your profitability might be. Without cash, the business dies. Now, this is especially true if you're in growth mode, and especially true if you're in a contingency fee law firm like we are. So this has happened to us over the past 3 years. Our business is booming. We're signing up more cases than we ever have, but the problem is when you sign up more cases, I've got to hire more people. Well, guess what people cost? They cost cash, okay? Mm-hmm. You have to develop more infrastructure. You have more seat licenses on our Litify system.
Yes.
You have to pay more Adobe licenses. You need more physical space. All of that drains cash, but yet we're not going to get paid for a couple of years.
Investment in technology is another big one, especially as we, more AI. Everybody's like AI. Even if they don't have really AI, they're adding AI.
Yeah. So in our next segment, we're going to talk a little bit about how Verne thinks about cash and how you can incorporate some of these concepts into your cash flow management strategies.
This podcast is sponsored by Mark Whitehead and Associates, a national disability benefits law firm. Mark Whitehead runs a firm of over 60 dedicated people whose mission is to make a difference in the lives of our injured and disabled clients. Mark represents disabled claimants in Social Security disability, private disability insurance, and veterans disability claims in all 50 states. Mark Whitehead is double board certified in both Social Security disability law and personal injury trial law. Mark has litigated disability cases in over 40 states and counting and can help your clients too. Stop throwing your phone calls away. Call Mark Whitehead at 701-VIP-LEAD. That's 701-VIP-LEAD. Or visit our website at disabilitydenials.com. Referral fees are paid in all jurisdictions where it is permitted. Refer us your disability cases today and know that your clients will be in good hands.
Okay, so we're sitting here. We're going to be talking about a little bit of cash flow. And as we alluded to earlier, so most law firms, actually all law firms, track the revenue They track their collections, they track their expenses, but most don't actually track the flow of the money. Cash flow equals timing and consistency of money entering the firm versus money leaving the firm, regardless of whether it hits the P&L or anything like that.
So talk more about what you mean by cash flow. I know you just explained it, but can you give us some specific examples of what you mean by that?
All right. Well, all right. So let's talk about the contingency fee firms for a minute. So it's a little different business model from, say, a flat fee firm or an hourly firm. So it all starts with the timing of the cash coming into the business. Okay, so frequently for us, it's 12, 18, 24 months between beginning work on a project, on a case, and actually seeing the cash come in. Versus, say, if you're a flat fee firm, say if you're an estate planning firm that charges flat fees, which a lot of our friends at Atticus do, they get a check right up front. Now, how they account for that may depend on their business model and on their state rules. Do you recognize that as income, when you cash the check? Do you stick it in your trust account and wait till the work is performed? On an hourly biller, you bill the hours and you send a bill out, and hopefully they pay it in 30 or 60 or 90 days or whatever the terms you have, or hopefully you have a deposit in your trust account that you can draw against, something like that. But all of those have to do with timing of cash in and cash out. And the bugaboos about cash are, you always have to remember the tax man. The tax man cometh. He ain't going away. You're going to have to deal with Uncle Sam and maybe your state, depending on what state you're in. You're going to have to deal with non-deductible items that you have to pay for that you cannot deduct. You're going to have to deal with, quite frankly, with partnership draws. I mean, we're not in this, for our health. We're in it to make money. So every month, if you're in a partnership or even if you're in a sole proprietorship, you're taking cash out of the business to basically support yourself. So all of these things are cash that exits the bank account. So ideally, you always want to have a positive cash flow. You always want to have more money coming in than you have going out. If you have a negative cash flow situation, you're going to, after a while, that's not sustainable, depending on what your circumstances are. So that's the first thing that you're always thinking about is, what is the timing of my revenue? How does the money get there? It's not when the money's earned. It's when the money actually hits the bank, when it becomes a spendable thing, when you can actually put your grubby little hands on it.
And from there, Verne talks a lot about a cash conversion cycle.
Right. And so it's really all about getting the cash in quicker. And this drives me nuts here at our firm. So we have lawyers that settle their cases. Yay, us. We've done our job. Where's the cash, people? We don't have the cash yet. You can't quit. You can't stop. You've got to get the release negotiated. You've got to explain the release to the client. You've got to get the client to execute the release. You've got to get the release back to the lawyer. Then the defense lawyer has to then request the check. And then the check has to be sent on to you. And then the check has to be run through the trust account. And only then do you get paid. This can take 30, 60, 90 days of just dead time waiting on the cash to show up. Well, my people still want to get paid. The rent still comes due. The electric bill still has to get paid. And so this is an example of, the cash conversion cycle of what it takes to get from the point of concluding the business to actually getting paid. And I think a lot of people neglect this particular point.
Yeah, I use the words or the acronym DSO, and it drives all the lawyers crazy, but that's a holdover from my oil and gas days. But number of days sales outstanding, basically,
Right.
DSO. So how long is it taking you to get from the time you completed the work until the time that you get paid? And we added a KPI to our attorneys for our lit. And, actually for our government, for our litigation files, for our governmental practice areas, we are now hyper focused on it because, as we've talked about on this podcast before, obviously Doge and those other things that can impact it. We were one of our, was it AHA, one of the listservs. It's taking upwards of a year. Is it in New York to get paid on your Social Security fees?
Yeah. I mean, you earn the money and it takes a year to get paid.
So these are very real things that at least those of you with governmental practice areas are going to have to start just paying attention to.
So breaking it down a little bit, so Harnish talks about the cash conversion cycle, the CCC. And the CCC is how long it takes to turn $1 spent into $1 received. And for law firms, it's often many, many months, if not years. So you kind of break it down like, first of all, you have the sales cycle. Okay, so I'm just throwing this out there, I run a TV ad, okay, on a Wednesday afternoon on General Hospital. And I looked at it today. That TV ad on General Hospital cost me $212.50. That's cash out the door. $212.50, cash out the door. Okay, if that ad does what it's supposed to do, it's supposed to generate a phone call from a worthy person, who has a worthy case that we would be willing to accept. Okay, so then we have to screen that person, interview that person, get that person to sign a contingency fee contract, and then that file needs to be transferred over to operations, to where we can actually begin the work on it. So that first part is called the sales cycle. Okay, so in the sales cycle, we spend $215 to get the case. We sign the case. Now the case has to move over to operations, what Verne Harnish would call the delivery cycle. That's the time it takes to resolve that case. Now that part of the cycle, God knows how long that can take in our world, in the contingency fee world. I mean, I've seen them happen as quick as 6 months. Typically, they're more like 12 to 18 months to 2 years to get through the delivery cycle. To me, the best business model in the world is the flat fee model, what the estate planners do, because they get paid cash. They get a check right up front before they actually have to do the work. Mm-hmm. Or they might split it, like they might have half down and then half when I deliver you the estate planning documents, or something along those lines. That is a beautiful business model because they get paid. They don't have to wait. Their cash conversion cycle is really compressed. I'm quite envious of those people. But we picked our lot in life, and we're going to live with it. So you have the delivery cycle. Then you have what Verne calls the billing cycle. That's the time to submit for payment. Okay, perfect example. We have a litigation case. We settle it. Okay, right. We've settled it. We've settled it in principle. Now we have to go through the cycle of actually getting the document signed, getting the case through, getting the check in. And then you have a collection cycle, and that depends. So this is really where the hourly attorneys get bit, is that they have a hard time collecting 100% of their bills. I coach a lawyer who has a billing practice, and they will bill, let's say a particular lawyer bills, I think their goal is they try to bill 5 to 6 hours a day. What does that work out in a week? That comes out 25 hours a week, 100 hours a month, and they'll submit the bill for 100 hours, okay? Their collections is actually not 100% of that. They typically only collect about 85 to 90% of what they bill, because they have clients that will come through and audit the bills and cut the bills and complain, and, you always want to keep your client happy, like, okay, fine, we'll take that off. He talks about this all the time, and then it takes to go through that cycle where they sort of dispute the bill. It takes them 30, 60, 90 days to get it worked out before they can even get a check coming in the door. So that's what they would call your collection cycle. And the reason I bring up these kind of 4 cycles is like if you break down any system, you can always look at ways to shave off time in each of these little segments. What can you do in your particular practice to shave off a little bit of that time to speed up that cash coming through? So what do we do in our case? What do we do to try to shave off time?
Well, and I think it depends on which cycle you're talking about. So obviously with our sales cycle, one of the things that we are getting very granular on with our intake is how long is time on desk, what I call time on desk, even if it's at intake, but how long is an intake staying open, either by source or by practice area? How long is it staying open? And then how long is it staying open at each stage?
So the first part in the sales cycle is the speed at which we sign up the case.
Exactly.
Nowadays, we want to do what we call one call closes. We want to sign that case up the moment they call in. In the old days, you would bring them in, you would set an appointment, they would come into the office. It might be a week or two before they got here. We don't do that anymore. No, that is ancient times. People nowadays, you want a 1 to 2 day sales cycle. You want it done quick. Boom, boom, boom.
Yep. And then moving to the delivery cycle, time to resolve a case. We talked about this in a prior podcast just recently about how you don't let the deadlines control your
workflow.
Well, yeah, your response time. So just because you have 60 days to respond to an SSD appeal doesn't mean that you take the full 60 days. And so I think those are very good ways that we've talked about resolving a case faster.
Anything you can do to move a case faster, anything you can do to grease the wheels and make it do what you can, format what you send to the government in a way that they can read it faster. Just anything you can do to shave a couple of days off the cycle time.
Yep. I think we're talking about trying to create a person just to handle the appeals because we're just getting to that point so you can create dedicated people in silos for that just as you get bigger and you can scale up. Hey, scale up. Hey. And in the billing cycle, obviously, if you can just get your invoicing done as quickly as you can, I say invoicing, for us, that would be a closing statement.
Right.
If your closing statement is ready and, just as soon as the attorney can close.
If you're a PI firm, you need to have the liens resolved prior to the time that the check comes in. Start that process early. You can decrease your cycle time by getting the lien resolved.
And on the collection cycle, one of my old bosses used to say, you want to have somebody who can actually call somebody else to, you want
pest. You need to hire a pest.
You do, because you don't want the person with the relationship. You don't want your attorney. One, it doesn't make good sense for what you're paying that attorney. But also, your attorney probably has a relationship with that opposing counsel and doesn't. They're going to tiptoe around it and be real gentle. Hey, man, will you please send me that invoice? If you've just really got an AP clerk or someone just with an AP clerk signature,
accounts payable.
Sorry, yep, an accounts payable clerk signature. Just say, hi, my job is to this is my job. And it's a lot easier received because people recognize that, hey, this person's just trying to do their job and trying to get their money in. Okay. So I think that those are some ways that we do that in our firm.
All right, so we've beaten a dead horse here. We're talking about cycle time. Improve your cycle time. Cycle time. Then there's Verne Harnish what he calls the 7 levers of cash flow improvement. These are 7 things that you can look at within your firm, where you can improve your cash. And even if you just improve it by just a little bit, I think he talks about try to improve it 1% every day, just 1% a day. And the first lever, and we've talked about this before, is price. Try to figure out a way to increase your average fee per case. Mm-hmm. Now, in a contingency fee world, how do you increase the average fee per case? Because we're pretty much all working on the same 1/3 and 40% of litigated type situation. Okay. And quite frankly, that could be examined. I know some lawyers who charge 35%, or charge strictly 40% across the board. I don't know if that makes sense or not. Doesn't work for us because we're government regulated at 20 and 25%. But, I think what it really means for us is improve the quality of the cases that we accept, number one. And number two, push our cases as hard as we possibly can to squeeze every last dollar out of them. On our government cases, it doesn't work because all we're doing is winning and losing. We're not negotiating settlements there. But on our insurance claims, we are negotiating settlements, so there's a big difference between settling a case for, say, $50,000 and selling it for $55,000. Just that little extra 10% that you might be able to squeeze out of those sort of like smaller to mid-level cases if you just tried a little harder, if you just leaned on them a little more, if you sent a deposition notice to one of their key people that they don't want to allow you to depose, like, all right, I'll put an extra $5,000 if we can make this depo go away. That happens all the time. So just anything you can do to increase the average fee per case, even if it's just 1%, over time that really starts to add up. So you need to think about that. I mentioned my hourly client. I think he bills too low. He told me what his billing rates are. I'm like, I sent him an article about some litigation that I had read about where lawyers were billing $1,000 an hour. Like, dude, they're not as smart as you are. You can bill that, or at least raise your rate. Raise your flat fee if you're a flat fee lawyer. It doesn't have to be a lot. Raise it 5%. Is anybody going to notice? Probably not. But you will notice. You will notice.
You mentioned our estate planning friends, and I think that recurring revenue can't be ignored, and I think that they also do a great job of that. In the
good ones do.
And I'm not quite sure how it works, whether it's like kind of on a monthly care program or something.
They usually have some sort of subscription type service that they set up where they do an annual care program, an annual review program, and it's just a way. Number one, it's a great marketing tool because it keeps you top of mind with your clients, but also it's a great revenue tool. Just recurring revenue is a beautiful thing.
Yep. And so I think we talked about this a little bit on our Clio podcast and how AI was changing billing models and, retainers versus, it's just, you're always going to negotiate an hourly fee. So what are some other levers, Mark?
Next one, volume. All right. So the first one was average fee per case. The next one is just get more cases. Now that doesn't mean take crap cases. That doesn't mean take unprofitable cases, but basically what it means is it improves your marketing and sales function within your firm. Get more good, solid cases, which means you got to be a better marketer. You got to be better at converting those marketing leads into sales. You need a good intake process, a good intake system. Those are the two babies that I'm in charge of in this firm. I'm in charge of marketing. I'm in charge of intake, although I make you do most of it, but
I'm just so glad, guys. This is recorded, right?
Yes,
you I
finally acknowledged that I sloughed most of the intake stuff off on Diana, but I'm still in charge of it.
You're in charge of everything, sir. One of the things that I think about with volume, and it doesn't apply to our firm, obviously, but customer concentration. So maybe for your hourly client, like if you only have like one client that's 70% of your business, probably not a good idea.
Ooh, that's dangerous.
Yeah.
That is way big time dangerous.
Or if you get all your referrals, I think that's the fireproof.
The Mike Morris model where he got all of his business from one source and all of a sudden one day the source blew up on him. So.
Yeah. So a couple ways to think about volume.
So be careful about that. Diversification is great. Direct costs. Keep your costs low. Negotiate your expenses across the board. We do a lot of things to try to keep our costs low. That's probably beyond the scope of this podcast because I could think of a million ways that you could shave off a little bit here, a little bit there, but you're in charge of that. Give us some examples.
We've talked a lot about don't get into long-term contracts.
Oh yeah, don't
do that with your vendors. I know that we hit that one a lot. But also utilize AI where possible. So many things now that you can do either with free AI that you used to need a vendor for. So not trying to put anybody out of business, but just try and re-examine your cost structure. I don't know if we're going to talk about this, but zero-based budgeting. We did I think we've done a podcast on that one, but regardless, just making sure you're always looking at your expenses.
Figure out ways to do things cheaper. I think the best example we had was, we used to use companies that did medical record summaries. Well, I'm paying them $35 an hour, and I know what I realize is they're paying nurses in the Philippines $5 an hour. Than that. Mm-hmm. So, all right, bypass the middleman, and we developed a cadre of nurses, and they're awesome people. We love them. And we pay them even better than their $5 an hour. And they love us. And we've saved so much money. by doing that. So it's a beautiful thing. Well, that was actually the next one was operating expenses. I think I've conflated the two direct costs.
I think I did that with your zero-based
It's
budgeting.
okay. We're still talking about expenses.
Yeah, so the fourth lever is operating expenses.
Yeah. So cut it where you can. Renegotiate those leases when you can. I don't know. You're in charge of this. Give me some examples.
Well, I mean, I think the zero-based budgeting, I just talked out a turn on that one. But yeah, I just think that sometimes you can, you just end up compiling things. And now with different vendors, sometimes we end up looking at some marketing things we can move to actually, that was one of the things we did with our new text vendor. We moved away from one vendor and we moved to Banjax because they were able to do it a lot cheaper.
Right. The next one on the list is accounts receivable, and he's really talking about the cycle time, and I think we just beat cycle time to death in the few minutes ago, so I'm not going to go over cycle time again, but basically just get paid faster. Don't let people owe you money. Get the money in hand.
And be proactive. I think that's one of the lessons that we've had to learn. Don't wait till you get the money in hand, or don't wait till you get, be prepared. Get your closing docs ready if you're going to mediation or
Right.
those types of things. As much as possible, let's get ahead of the game.
Get that pest going and have harass. Get the money in the door. Inventory, this is kind of an interesting one. I don't know that it really directly applies to a service business because we don't keep inventory per se.
Cases are inventory.
We often refer to our cases as inventory. They are inventory, but that goes back to cycle time.
So here's what I would say about
you don't want to reduce the number of cases. You want to increase the number of cases. So we are opposite of most industries who want to keep their inventories lean and mean. We want to keep our inventories big and fat and puffy. We just want to keep the cycle time down.
So what I will say about inventory that I think about is that you want to eliminate your C cases as fast as possible. And that is so hard, I think, for our team to learn because we do like to keep things fat. Everybody thinks of high case volume as, security for the firm, also job security.
Okay. You took this in a totally different direction, but it is brilliant.
Why, thank you. That's why you hired me.
That's why I hired you. So I don't necessarily view our good cases as inventory in a negative way. That's a positive thing. But our bad cases, our cases that should be cut, that remain in our inventory, that is a bad thing. That's where, that's the bad type of inventory that you do not want to have in a law firm. Cases that are eating up time, resources, money, and are never going to produce enough money to justify their existence in your firm.
And the worst ones are the C cases that you hang around for 200 plus days. And
oh my
you get
God! Yes,
$2,000 in attorney's fees. Like just guys, let's watch your.
And it is the C cases that hang around the longest because they're the ones that get neglected because the lawyers know they're C cases.
Yes, and you just want to make sure that they know you're watching.
Get rid of them fast. The last one is accounts payable. Now this is a funny thing. I had an old crotchety business professor back at Texas A&M, decades ago. And he goes, the cheapest loan that a business can get, and I'm not advocating this, but I'm just telling you what he said. I go, what? And he goes, just don't pay your vendors. Yeah. And he goes, what are they going to do? Let's be nicer about that because we love our vendors, but you can get favorable repayment terms from your vendors.
Everybody should have terms on all of your vendors. If you don't have terms on your your top 10, not your payroll vendor, obviously, guys, but if you don't have terms,
net 30 days minimum. Sometimes you can get net 60 days. You can get net 90 days. It's sort of the equivalent of so we used to have, back when we did more depositions, I would have court reporters who would do the court reporting on a letter of protection. In other words, they would agree to withhold billing me for their court reporting services until the case resolved. Mm-hmm. That was great back in the day when I used to pay cash for all my expenses. Now, nowadays, we have a line of credit that we use. So I don't think I would burden a vendor that way now. But back in the day, we used to do that. But getting favorable terms, payment terms, stretching out your payment terms from your vendors, these are things, that can balance out the cash flow, particularly because we're putting all this work on the front end of a case and we're not getting paid for 12 months, 18 months, 24 months. If you can push your costs off down the road, that helps really balance out the cash flow.
I mean, I think it's obvious, but just in case it's not, make sure you're inputting your expenses into like QuickBooks or whatever you're using as net 30 or net 45, because don't just input them and not think about a due date.
Okay. So when we come back, we're going to kind of conclude with some of our closing tips on how to manage your cash flow and maybe some resources that you can go and do a little research on your own. I'm Mark Whitehead, a lawyer, entrepreneur, and business coach. Thanks so much for tuning into the Successful Barrister podcast. We have a blast creating it, and I hope you find it helpful. If our chats have sparked your interest, I'd love to hear from you. Shoot me an email at mark@markwhitehead.com. That's Mark spelled with a C. Enjoying the Successful Barrister newsletter. Even better, let's hop on a call. I'd love to chat about how we can collaborate, share ideas, or just catch up. A couple of tips that we have developed that Verne Harnish has advocated to manage your cash flow better. Number one is the 13-week cash flow forecast. Now, we don't actually do the 13-week. We sort of do it a little slightly differently, but he advocates for 13 weeks. What does 13 weeks equal?
A month. A quarter.
Oh, my God.
A quarter. Guys, it's Friday. A quarter.
Let me try that one more time. What does 13 weeks equal?
A quarter.
A quarter. Thank you very much.
I was so happy with my response.
I want to know where you come from where there's 13 weeks in a month.
It doesn't matter. So talk to me about a quarter.
Friday, I'm just blown. Okay.
Mark's reading and thinking.
In other words, what Verne is advocating is a quarterly cash flow forecast. Like, you need to look out on a quarterly basis, and I would advocate, if you're going to do it on a quarterly basis, you do it on a running quarterly basis. In other words, always be looking out 3 months in advance, not just a static 3 months, because then you're in month 3. What are you doing then? You're not paying attention. So I would do a running 3-month forecast of what you expect your cash to be over any 3-month period. Does that make sense?
It does. And I think that makes more sense for your hourly billing client, because you can kind of project more or less or guesstimate like what your inflows will be. It can be harder for us to project 90, 120 days out. But I think for some other types of fees, it might be more.
Yeah. Now, he advocates for a daily cash flow dashboard. Now, we don't do this. We do it weekly. So every Monday, we have our finance level 10 meeting. And in that finance level 10 meeting, we look at the cash that came in for the week. And then we look at the payables that are due that week. And, I do my mental gyrations in my head. $100,000 came in. X number of dollars can go out. Okay.
And whether you have payroll that week.
And whether we have we always factor in whether it's a payroll week or not. So I will agree to drop these 3. So the first thing I do is anything under $1,000, I usually, all right, drop everything under $1,000. And then I start looking at the big bills. Like, we may have a big $30,000 software bill or something that comes in once a quarter. And I'll say, do we drop that this week? Do we hold it until next week? Or hold it for 2 weeks, or whatever it is. But every week we're looking at cash in, and the cash in determines how much cash is going out. And again, I'm doing a little bit of vendor management there. I know what vendors will let us slide, and I know what vendors won't let you slide.
Yeah, and I know this one's obvious, but just in case it needs to be said for some of the smaller firms, you're looking at your QuickBooks balance.
Yes.
Not your bank balance in the portal.
Yeah, the bank balance in the portal is not the true measure of what you have. That is always overstated, because you have people that take forever to cash the checks.
Yeah, it's a good way to bounce some checks. So
that's a good way to bounce checks.
We're looking at our QuickBooks balance on Monday.
Yes, so we're looking at your actual QuickBooks balance. But anyway, every Monday at 10 a.m. Central Standard Time, this is what we do. It is ingrained in our brain that every Monday at 10 a.m. Central Standard Time, this is what we're doing. The triple reconciliation reports. Now, this has to do more with balancing your trust accounts. But a lot of times you have money stuck in your trust account that ought to be moved into your operating account if you're not paying attention. If you're an hourly biller, are you billing against the trust retainer? If you're a flat fee and you're having to draw against the retainer periodically, that's another thing. If you're a contingency fee like us and the money has to be split out, did you get all your money out? Did you get all your expenses out?
Did your expenses get put on the closing statement?
Yeah, did your expenses get put on the closing statement? All of this has to do with the triple reconciliation report, which is what your accountants typically should be running for you, because I think lawyers, we suck at this generally. The cash flow statement. This is something new for us. We did not have a cash flow statement until this year, and our friend Daniel helped us develop a cash flow statement.
Yes. Well, what we call a cash flow statement.
What we would call a cash flow statement.
Yes.
It's a modified version, but it works for us, and we look at it every month. And what it does, it also reminds us how much money, is owed in taxes, how much money has to go back to the bank in terms of principal, how much I, Mark Whitehead, am pilfering from the law firm.
You were going to admit that one too.
To pay for all of my nefarious expenses, all my gambling debts, all that fun stuff. So it accounts for all of the cash, not just profit and loss, but I see where all the cash goes.
That is one of the most useful tools I think that we have gotten into our stable of accounting reports. And I think we're still even learning how to use it.
Yeah, it's still a work in progress. I mean,
Yeah.
I've noticed we screw it up occasionally and we have to go back and fix it. And,
Yeah, we have to tell Daniel we broke it.
We go call Daniel, what did we do wrong? But it works. And it actually kind of gives me some level of comfort in knowing, what the hell happened last month. Like, oh yeah, my daughter got married and I had to take a lot of cash out of the business,
Very simple, inflows minus outflows. You
Yes.
think that it's easy, but it was
Right.
It was hard to set up.
Okay. So a couple of metrics to look at. The cash you actually collect versus the cash you forecasted that you would collect. If there is a difference, why? Mm-hmm. What went wrong? What went right? Okay. But you always need to look at, what I would call the budget versus actual. In other words, what you predicted would happen versus what actually happened, and understand the reason. The importance is the why. If it's a reason that you understand that you can explain, perfectly fine, But if you don't understand why, you better figure out why, because something went wrong.
We've talked about time on desk. How long, or days sales outstanding, basically. That's a different one. DSO. How long is it taking you to actually get your money in the door?
Yeah. So one of the things I look at is unreimbursed costs. Okay. So we have cases that we have to shut down without a fee, where we have expended money developing the case. For example, let's say we sign on a case, we go get the medical records, we look at the case, turns out the case just isn't going to fly, and we have to tell the client, we can't help you. Well, we've expended money on that case. We have to reimburse that money, and we do that every month. And so that is a number that I look at. And is that number getting really, really big? If it gets really, really big, what is that telling me? Because I'm always looking for the why. We keep the metric, but what is the metric telling me? It's telling me we may need to look at our intake criteria and be careful about the cases we're taking.
You have too many C cases.
We're taking too many flyers. We're taking too many risks because our unreimbursed expenses have just gone through the roof.
Or you have a process breakdown.
What happened? Exactly. Yeah. What else you got? What other metrics we're looking at?
A lot of our Atta cousins, we've talked a lot about this, was how much cash do you keep on hand?
Yes. This is a big debate.
And I think just depends on how you're really set up. How many partners do you have? Because you're the only owner.
I'm a sole owner, so
you have a lot more pots to pull from.
I have a lot more freedom with which to manage the cash because I don't have to answer to other partners, which, in my case, what that means is I don't keep a lot of cash on hand within the firm. I move the cash out of the firm and put it into my personal investments because I can. And if the firm ever runs dry and has a cash flow problem, then I pull it out of my personal investments and I just make a capital contribution back into the firm. I can do that as a sole owner. Mm-hmm. If you got partners, it doesn't work that way. You have to come up with some partnership agreement about how you're going to allocate revenue shortfalls.
Yep. And so, I mean, the reality, what that really means is instead of having just cash sitting in an account, not doing anything for you, it is sitting in an interest-bearing account.
It's sitting in an investment account that should be making money, should be earning 6% or better.
So, you have that flexibility, whereas many law firms don't. So I think Atticus generally says 2 months, keep a 2-month cash buffer. And I think that's just a good rule of thumb.
It is a good rule of thumb. What would happen if no cash came in for 2 months? How would you survive? Can you weather that?
Oh my gosh.
I know, you're getting hives just thinking about it.
I really am. That's too much for a Friday afternoon, Mark.
Oh my God. All right, let's don't ruin her weekend.
But it's a good strategy, good mental exercise to think about with your leadership team.
Right. I would think the very last piece, and for those of us who have larger firms, typically we will have lines of credit with banks. You need to keep a handle on your line of credit and what that is actually costing you, and to keep that at a reasonable level. And I know you're rolling your eyes because you're like, I know what your line of credit looks like. And I'm like, yeah, okay, I know. Taking some chances out there, in financing them with a line of credit.
It's yours to play, and
it's a great thing.
It is a very legitimate gambling expense.
We put a lot of money into mass torts, and ideally it should pay off in the next 12 years or something. God knows when it's going to pay off, But
yes, your line of credit, that's another one that just sneaks up on you.
It can sneak up on you if you're not careful. So always be careful about managing the line of credit. That is definitely part of the cash flow management strategy. So with that, I'm getting the high sign that Diana wants to go home on a Friday afternoon.
I don't know what they're doing.
We got to wrap this sucker. So I want to thank everybody for listening to the Successful Barrister podcast, where legal legends are made. I'm Mark.
And I'm Diana.
And together we're the dynamic duo of law. So I want everybody to remember to rate and review us wherever you get your podcast. And if you've enjoyed this podcast, tell your friends, spread it around. Add a friend today. Say, Mark, could you text me the link to your podcast? So the link to the podcast is very textable. It's a great, just pops right into the iPhone, no problem. And visit us at at successfulbarrister.com. Just successfulbarrister.com. And remember to visit our sponsor, Mark Whitehead & Associates, a national disability law firm, at disabilitydenials.com. And with that, we're out of here.
Bye.